Like there's um, a lot of things that can go wrong with the big optimism, and that's why portfolio hedging is so important. You don't necessarily want to go to cash here, but at the same time, you have to have a way of managing that tail risk. I mean, a stock market that's gone 70% in 2 years, at some point is going to mean revert. There's going to be some stage where the stock market is going to do what it always does, and that's going to catch everyone.
I'm always excited when I get a chance to talk to Big Picture Trading's Patrick Ceresna. But you might know him from Market Huddle. Our friend Kevin Muir, of course, and Eric Townsend. He does with Macro Voices. Great stuff, by the way. Great broadcasts.
Thank you, Mike.
He keeps Eric on track there, giving him all the weekly updates, what the charts are saying. Well, I want him to do that for us today. Patrick, thanks very much for taking the time.
Oh, thank you, Mike, for having me on the show, bud.
Let's talk about the environment we're dealing with. I mean, hard not to talk about the post-Trump, hard not to talk about the momentum that the market's clearly shown. I mean, I'm in that camp, by the way, Patrick, where I start getting nervous now, that I'm not sure, maybe because I'm old and I sort of need some, you do technical, of course, and I love it, but, some sort of sense that I'm getting a good value here. And it's tough in this environment.
Oh, absolutely. And it's they always have that adage of it's when the last bear turns bullish that the market tops come in, and I think that there was a true sentiment shift when the Republicans swept in there, and the optimism just poured in because the amount of anxiety that was going into the elections with so much uncertainty as to whether this was going to be a contested election, whether there was going to be some mixed outcome. And so there was a lot of hedging, a lot of nervousness, a lot of people on the sidelines. And when there became pure clarity afterwards, suddenly everyone realized that, well, their portfolios were not necessarily positioned for this outcome.
Yes.
And it created almost like a tidal wave of money that came pouring back into the market that created this what was just a spectacular 1 month rally in the markets where we're today.
Have you seen enough to make you suspect it might be a time to be cautious? Obviously, everybody's got their own risk profile. So that's the first thing you should start with is what's your risk profile? What's your appetite for risk? But just a broad answer. Have you seen enough in the technicals that you look at on a momentary basis to suggest, hey, that rest period may be coming or a correction of significance?
Well, for the remainder of December, things are likely to remain quite quiet. I mean, beyond a surprise from the FOMC next week, where really there is no economic news catalyst. Of course, there could be a geopolitical event or something that could stir up the markets. But right now, I would imagine that the next few weeks are going to be rather boring, both to the upside or downside. I think the market's going to be far more quiet in a technically more of a toppy formation where it starts reaching resistance, but no reason to sell off. And that could be the story going into early January. But every market inevitably corrects. The interesting part to me is, the market has numerous times throughout the last year gone from extremes. And so as an example, at the start of the year, there was a point where everyone was sure that the Fed was going to come in and cut like 7-8 times in this year.
Yes.
Suddenly we got into a couple months later, and suddenly they took all the rate cuts out and everything was great and everything was fine. And then a few months later, we were back to them pricing in 7-8 rate cuts again. And so the thing is, the markets seem to be going and into like the schizophrenic mode of like, what is the mood of the market at any one moment? And so I kind of reflect on what's the current state of the market. Well, currently, even bears like David Rosenberg are throwing in the towel that basically, forget treasury bonds. These bubbles can last longer and go farther. And you basically have everyone stop talking about the narrative of soft landing, hard landing. That literally has now become consensus that there was going to be no implication for this massive rate hike cycle that the Fed has done over the last 2-3 years. And the question then is that could we be in a scenario where data points start to come where people have to once again start pricing in recession risk or start
Mm-hmm.
pricing in some of these other outcomes. Right now, it's a true Goldilocks scenario. Everything pretty much has to stay perfect into the first quarter of the year in order for stock markets to stay at these valuations, these multiples. Everything has to just keep compounding. All you need is a couple of these Mag 7s to start missing in the January quarter, and you can have all sorts of question marks start to appear. You know, the one last point I would make in terms of recession risks, like I don't want to go and say there's a guarantee of a recession, but if you look at the rate hiking and cutting cycles and how they've correlated with economic recessions, in the past, you've seen where, for instance, in 2000, it was November of 2000 where the Fed started cutting interest rates. The recession didn't come until early 2021. You have the Fed started cutting interest rates in middle of 2007 in the financial crisis, but the recession didn't come until the middle of 2008, over a year later. The
Mm-hmm.
thing is the Fed only started cutting interest rates right now in August. And, you know, we've seen in the past where recessions can still happen even a year after a rate cut cycle has begun. But yet somehow everyone is jumping to the conclusion that because a recession was avoided from the rate hikes, that somehow now it won't happen. I'm just saying it's still on the table. You can't say it can't happen. And everyone's like, but then Trump, you know, like there's um, a lot of things that can go wrong with the big optimism, and that's why portfolio hedging is so important. You don't necessarily want to go to cash here, but at the same time, you have to have a way of managing that tail risk. I mean, a stock market that's gone 70% in 2 years at some point is going to mean revert. There's going to be some stage where the stock market is going to do what it always does, and that's going to catch everyone.
I loved your phrase though that, and it's a recognition that everything is priced so beautifully. You know, it's priced to
Yeah.
perfection, as you said. Let me come to just what you've said there. So, an easy way of, and I think not enough people are thinking there's somewhere in between selling everything and buying everything. And I know, of course, with bigpicturetrading.com, you train traders, but you
Yeah.
also talk about options. So I'm just wondering, is the most straightforward way, I guess you could buy an inverse ETF, as an example, but about buying a put option, as simple as that. You take maybe a major position, maybe even somewhat out of the money, but it's still
Yeah.
protection to buy that insurance. And just to keep everyone up to date, a put option is I buy it and it allows me to sell the buyer, or I buy the put and allows me to sell the person who issued the put, at a certain price for a certain security or the overall market. That was probably the worst explanation you have ever heard, Patrick, as I stumbled
Maybe.
through it. but I'm
the
asking, is that as simple as it is, to get, I love the
I
idea of getting some insurance.
I feel that if you were to insure the market, it actually hasn't been cheaper in a very long time to buy downside insurance. This is the crazy part. But I look at it from, let's say, a portfolio perspective.
Mm-hmm.
So rather than buying it on individual stocks and having the right to sell them at a fixed price, like an insurance policy on your stock at a price, I look at it about the downside exposure of market. So as an example, let's say you have $1 million portfolio, and it's diversified enough that you feel that it's going to be somewhat correlated to the movement of the S&P 500, and that you've got basically something that's moving like the markets. Right now, if you buy a 1 quarter out, so going out to, let's say, the end of March, to buy a put protection that basically protects all downside risk in the stock market below a 5% drop. So you take
Mm-hmm.
the first 5% downside risk of the market, and then insurance kicks in. Basically, an insurance policy like that is just over 1% of the value of what exposure you want to
Yeah.
have. So like if you basically been in the stock market for the last 2 years and you're up 50% or 70% on your portfolio, to give 1% of your gains back, to have the certainty of knowing that if the market suddenly goes and has one of its traditional 10 to 20% market corrections that happen every few years, that your downside risk is gone beyond the first 5% decline. And so, there's a point where you want to weigh the cost benefit of not being insured. Not enough people know about how the insurance works. But it's just one of those things that you can just overlay straight into you don't even have to touch any of the 20, 30, 50 stocks you have in your portfolio. You literally just go and buy a blanket insurance on the S&P, because what you're really hedging is market risk and not individual company risk. I'm sure you have a very specific reason to own each of the companies that are in your portfolio. But what you're trying to hedge is the whole stock market having an event driven by liquidity catalyst that is presented, that irrespective of the quality of the company, all companies, like when the tide recedes, the value of all stocks pull back. It's just the natural byproduct. And that's what you're sort of ensuring with that.
Well, and I'm really wanting to emphasize this point, because you get into a bull market, a bull phase, the way we've been, and people's psychology goes in one direction usually, or a huge mass of it. But we do recognize there's some risk. And my point is, some people may have their overall portfolio up 30%, and if you're talking about paying just such a small proportion, give a little bit back. Don't be, maybe it's not greed. It's just you're ill-informed on it. Boy, that seems like a prudent move in this environment. I mean, I think we can both name just a ton of risks. You mentioned geopolitical just briefly. Come on, that is definitely on the table. But gosh, so to pay 1% to sort of protect that 30% you've made in the last year, that seems like something that we should all be talking to our financial advisors about.
Right. And Mike, the part to kind of emphasize, what's the alternative? So a lot of the listeners would say, well, I'm up 30%. I should sell some stocks, right? So raise cash. So maybe I go from being 95% fully invested in the stock market to being 75% invested, and you start taking some profits tactically on different things and raising cash. The trade-off is that if you got your timing wrong and the stock market keeps proceeding, you are not making that money of the stock market continuing higher. The thing is that when you spend this 1% on this insurance,
good point.
If the stock market goes and rips another 5 or 10% higher, well, you're still invested and you're still making all that money from the market continuing to rise. So it's not even just a 1% cost. It's a 1% to keep you going invested without you starting to par off your positions and close down your portfolio because you're starting to get nervous. Well, if you're nervous, buy the insurance and then you can stay fully invested.
That's just such an excellent point. And obviously some people aren't familiar with this. It's very straightforward. You're buying a put, so ask your advisor, I want to buy a put, or just look it up online. It's straightforward. It's an insurance policy, allows you for a period of time to sell at a specific price, and it's just like buying a stock, you know what I mean? You go on the market and you buy it. But I just think that advice is great. And your last point though, is that, hey, there's some people who don't sell because it's sort of a FOMO thing going on. Right. I don't want to miss out. Well, this is sort of the best of both worlds. It's protection, but if the thing keeps ripping higher, let's say you were lucky enough, and keep this in mind, Patrick, it was May 2022. We were talking NVIDIA on this show. And, all the way up, you could have thought, I better sell. Well, this would be a great example. You buy a put, you're still in it for the next 100% move.
That's exactly it, right? Like it's one of those scenarios where you want to think of it like car insurance. Like in the end, you're not hoping to crash your car because you bought the insurance. You hope that the insurance expires and that it was just an expense to keep you driving. But yeah, that if you total your brand new car and have all sorts of liabilities, that the insurance company covers it. And so you almost don't want to look at it as something that you want to work. You actually hope that you don't have to use it.
Yeah, yeah. Let's talk about,
Yeah,
I'm going to shift gears for a second and
yeah,
get a
yeah.
couple of comments on different groups that I know you follow technically. Let's start with the gold.
Yes.
We got a little dip after the, sort of October 30th. I'm picking a date out of nothing, but,
Yeah.
we had that rise into the end of October. Where do you think it's at this point? I'm one of those guys who wants to buy on the dip. Okay, I'm a
Yeah.
long-term
No.
bull.
I'm a long-term bull too.
Yeah.
And the when we were originally in October up at the $2,800 level,
Hmm.
the optimism was simply too bullish. That what ends up, and this is why even the stock market will correct eventually, because when enough people get bullish and they're all in, inevitably leverage starts to occur, and then ultimately there's a deleveraging. There's a period
Yeah.
where suddenly all these people that went too far realize they put too much, and then they overwhelm the sell side bid, and they basically spur a correction cycle. So gold went through a correction, but gold correction was as textbook as it comes. It was close to a 50% retracement of the prior rise, right down to the moving averages, a very traditional profit taking cycle that happens in the midst of a bull market. And the last 2 days, the breakout above 2,700 was critical. And now, with the fact that silver is following along, you have to really consider that the breakout, literally, we're just seeing in the last 2 days, could be signaling the start of a new leg higher. And just using the rules of symmetry from a technical perspective, the next target is 3,000. And so that's a very realistic first quarter target.
Hmm. So, and again, it reconfirms. You mentioned silver. I'll just get you to elaborate just for a touch on silver because lots of people own both. We were giving
Yeah,
away 1 ounce silver coins at the Outlook conference a couple of years ago because it was like $13. You
yeah,
know, we're
insane.
not quite as quick to do that now at 30.
Yeah. Not so much, but silver, it's been a laggard to gold, and largely because it's really the story is all Kevin talks about on the market all the time, but like the Bank of China, and the buyers in Asia are just scooping up gold directly. Silver is not their focus the same way
Hmm.
gold is, and so what you're seeing is the predominant buying pressure coming in the gold market. But silver has this factor of, well, kind of lags, and then suddenly explosively not only catches up, but then exceeds. It's like the implied volatilities on silver are almost double that of gold. And so you basically have a lot of pent up energy in there. And so right now, silver is a bit of a laggard. It's a little bit of quiet, but it actually turned up. Unlike platinum and palladium, which are grinding their heels and like just like stuck in the mud, you have a scenario right now where silver at least is trying to break out with gold, and if that's the case, we could see $40 an
Hmm.
ounce on another breakout.
And I know time's short. You know what it's like on these
Yeah,
podcasts because you do Market Huddle, you do Macro Voices.
and they're
So
3 hours long, right?
yeah, but I'm skipping around all the time here. But I don't want to let you go without talking about what you're seeing in the energy market, especially oil and nat gas.
Yeah, well, the sentiment could not be any more negative on thing like Eric Townsend at Macro Voices has been a huge oil trader for most of his career, and including having an oil hedge fund. And it's not that he's even bearish; he's just not even interested anymore.
Mm.
It's and there's this sentiment thing of where it's just everyone has kind of said this is not where the money is, and they've seemed to have left it for dead. What is interesting though is the divergence from oil and energy companies, and so energy companies got this huge boost from the fact that there's this Republican government and all this, ESG stuff is going to be unwound, and these companies are going to be allowed to profit again and run great businesses. So there was these energy stocks were doing much better than oil. So if you're just talking oil stuck, and it would not shock me with the amount of times that it's testing these kind of $65, $66 lower support line that it technically does what I call a turtle head formation, which is basically it runs all the stop losses sitting below that support line. I wouldn't be shocked if we had a quick drop down to like $62 in the short term. And I've been telling my members that if we got that kind of a dip, I'm buying it. And so I think that that would be a quick opportunity. I think that the right price for oil, like maybe an oil bull market is still maybe years away from when these imbalances kind of sort themselves out. But I do think that there's a very reasonable assumption that we're on the much closer to the bottom than the top. And so when you're looking at something from like a covered call writing perspective or a put selling perspective, earning income, we've been nonstop income writing on crude oil futures, just coming in there and selling income, because I don't see a huge downside, but also no immediate catalyst for the upside. So you might as well income write on it and take advantage of these kind of lower support lines.
Another thing then to check with your financial advisor about selling some calls. If you're sitting on some of these quality oils, you don't want to get rid of them, and you sell the call and you take in. I mean, that's one of my favorite strategies because it's conservative, and I love to see that cash flow keep coming in. Let me finish with this. You've been bigpicturetrading.com, bigpicturetrading.com. You train people for the investment markets. You've been involved yourself for decades. Just what comes to mind if I say, well, what was one of the really big formative lessons you learned? I mean, I can name a few that I certainly have, painfully learned over the years. But what comes to mind when you're sharing it with the people that you help train?
The most painful lesson I've learned the hard way is I find that I create my own biases in the market. And I'm looking at the macro, I'm looking at the technicals, and everything is, let's say, for instance, I was never a coiner. So I never bought Bitcoin. I was always a no coiner. And yet I would sit there and I would say, well, okay, there's all the reasons why Bitcoin can go up. Technically, I see it's actually breaking out. But I've convinced myself, no, I'm a no coiner. I'm not going to buy it. And yet there's all this money. There's all this money on the table and this opportunity, and I basically have let my own biases talk me out of acting upon it. And one of the things that I continuously am trying to evolve is to be more agnostic, in a sense that, just look where the opportunities are and manage the risk and position yourself properly. You can be diversified, you can do all sorts of different things, hedge. But if there's an opportunity, be open-minded enough to consider it rather than being stuck in your own kind of old ways of thing. Like it's so hard to do.
Yeah, I hope you see me nodding my head because, in a serious way, the same thing. I mean, I always wonder, even to this moment, if I'm looking at information, whatever, am I talking my own book in the way I'm absorbing it? That I need it to go up. And I've observed that in so many different people who fall in love with stocks, so they can't really, but we see it in politics all the time too, which is, I think, in fact, it's easy to see how detrimental it is in politics when your partisanship sort of negates the any kind of fact that coming in, you have to ignore them, and then we end up in many of the situations we're in today. And I'm not knocking one party or another because they both do it.
No, it's not even just politics. Look, I'm a diehard Leafs fan. Look how that's turned out for me. Like this is these biases happen in politics, sports, and in the markets.
Sure.
And when it comes to making money, you have to sometimes be willing to be a bandwagon hopper, which is you got to be willing to kind of not always stick to the one playbook, but also be willing to adapt to how the things are changing.
That's just great advice. And let me again remind people to go to the Market Huddle. People in Money Talks know Kevin Muir, also Eric Townsend and Patrick do macro voices, complete with the full market wrap up and market look ahead too with Patrick and what the technicals are telling him. And of course, I'm saying go to bigpicturetrading.com. Patrick, thanks so much for finding time. What a pleasure.
Thank you, Mike.